All right. Good morning, everybody. So the market had a little bit of a surprise this morning. Tesla continues to instigate a price war, lowering their cost on yet another model. That's affecting the EV stock everywhere. And then Target came out not hitting the numbers that they were supposed to hit, not providing a forward guidance that would have been rosy and positive, and yet they're still up this morning, which doesn't bother me at all because I've got a lot of Target, so I'll take it. There is FOMC minutes coming out today. This is not FOMC. It's a recap of the FOMC meeting. When Powell comes out on that day, and he kind of just gives a broad summary and then he answers questions. This is where they went back and they took a more formal approach and really decided, hey, what message do we want to send? And what data points do we really want to cover? And so they get it all wrote up and it gets released. So just to, kind of keep that clear, because I've had people mistake this for the FOMC event itself, and it's not, right? So we got Jackson Hole coming on the 26th. I know I started talking about it a little bit yesterday. Just want to kind of keep that in your thoughts that we do have Jackson Hole coming. And, last year, the whole mic drop, screw you, higher for longer, suck it up, big boy speech that Powell did in that little 30-second walk off the stage maneuver that he did, I doubt we're going to see it this year, right? He doesn't really have any reason to come out so aggressive as that. But if you are looking around this morning at why sentiment is down, say you're over on Finance Juice or something where they have these market wraps, a little bit of the sentiment on why it's down, the markets are behaving the way they are, is due to that higher for longer narrative. I call BS on that. It's not like they suddenly woke up and went, oh gosh, I think maybe these rates are going to stay up here longer than I thought. That it's been the same message, for a year. But the UK inflation exceeded forecasts, and they're anticipated to hike another 25 basis points. That ties in with the idea that the US is at least likely to raise one more time, although a lot of analysts are saying we won't get another rate increase. This is one of the parts of the meeting notes that are coming out today, is it's going to show us where the Fed officials were at within the group, right? They're not all a single voice. How many were arguing and were, convinced to go with the group? And what were they arguing for? So the anticipation is that there was only a minority of officials who favored keeping interest rates steady. So what were the rest wanting? And is this accurate, right? This is what we believe. According to analysts, this is what they think is going to show up today. So this is what we want to be watching for, because remember, it's surprises, right? The market doesn't like surprises. If everybody thinks this is what they're going to see, that's what they need to see, or the market's going to react to it pretty good. Other than that, we do have oil inventories today, or oil data 10:30, so you could play USO. It's always a favorite to me. I like playing the USO. Not too much, right? We can handle that. So if we look at the anticipation of previous events, we can see that FOMC minutes do have the capacity and have moved violently in the past. So kind of want to be prepared for that. For you 0-day traders, this afternoon, you maybe just don't want to do it, right? That's kind of the long end of the stick there. One of the reasons that I like doing 0 days is, you can run neutral trades and make $1,300 to $1,800, in like 45 minutes. Love it. And you don't even need to have a direction. How cool is that? But you don't want to try it every single day, because to make that kind of money, you got to risk that kind of money, right? And you don't want to risk $2,000 every single day, because your odds don't improve doing it every single day. Well, you kind of want to pick and choose. Today would be one of those days where you wouldn't want to do it. Looking at what's going on around the world, Hong Kong is down the worst, more than 3.25%. Japan behind them, nearly 2% to the downside. And then the Russell down 1% this morning. Bring that in a little closer to home, the S&P basically flat on the morning, and then the NASDAQ right behind it, flat, and the Dow right behind it, flat. If we think about the global wave, right, of where it starts in Australia, then over into Asia, then into Europe, and then into our markets. If there was a contagion, we would see it through the flow here. And really nothing stands out here at the moment. The China stimulus is certainly not showing up, and it continues to be front and center with these missed payments and the real estate issues, which are bleeding out into service issues, which are, right? If one group can't pay its bills, then the next group can't pay its bills, and it just widens. And that word contagion is something getting thrown around more and more now. And, that the Evergrande situation 2 years ago was a near miss of catastrophic proportions. I don't think it's done yet. I think this is just more of a ripple effect from that. Time will tell. So right now we're looking at US dollar Japan. This is a weekly chart. We do have this nice little scoop and the breakout level. On the anticipation of how far could this go before we get to another level of perhaps resistance, or at least a target, you can just measure the last candle, right? The last big candle. We'll have 0, a half, and 1. Don't really need the half. 1.5, 2, 2.5. So targets upwards. This is not new science, right? Go in and learn candle analysis 101. The first thing they'll tell you is measure the range and plot that range. Well, we might be looking at a weekly candle, but that's also 5 days, right? Or, how many hourly candles is that? It is a range. We're looking at 146.75 to the upside as the anticipated target for this breakout. The question becomes, if it's going to stall, where would it likely stall? And it would likely stall somewhere around that 111 area. We made it through the 111 area pretty well. Look at all those moving averages, cleanly distanced from each other. Nice fork pattern, all at a nice sloping angle. None of them are curled over. None of them are indicating weakness, and they're in the right order, right? This is like textbook picture perfect bullish market. It doesn't get any better than that. So that's US dollar Japan. This is where they came in and played whack-a-mole last year, right? So if they don't intervene, this thing is looking like a freight train. Kind of back that up to when they did intervene last year, and you'll see that nice, strong, bullish price action that we were just discussing, right? All the moving averages stacked nicely on top of each other, spread out, strong angle, a picture of health and strong bullish price action until they came in and hit it, right, with their intervention projects. And then a big one, which still wasn't enough. And then yet another one, which was globally coordinated. And that finally got the job done. So here we are again. And as bullish as this looks, as strong and as powerful as it looks, you got to consider the people who are looking at this saying, we got to find a way to slow this thing down, give it a good whack. Sending this to the downside last year sent the S&P driving higher. And it's not, I'm simplifying this a lot, right? So, it's not like this right here is moving the S&P. It's how they defend this. It's their interactions with the 10-year and what happens with the 10-year that affects the S&P, right? So I'm just cutting through all the noise and keeping it as simple as possible. The intervention here will directly affect the S&P in a positive way. So, all this talk about we're going down and we're going to see lower levels in the S&P that we saw last year. I mean, it's always possible, sure, but it's not my base case argument, right? The idea is they're going to come in and save this sucker, whether they like it or not, because of something like this. Okay. So, sometimes what you're looking for isn't in the candles of the thing that you're trading. We see bonds here this morning are up off of that low, which is really nice, but that's not really very comforting. This is a micro double bottom, and a good double bottom exceeds the previous low, right? It's a bear trap. It's supposed to trap bears. It doesn't trap anybody when it comes down and perfectly tags the previous low and holds that and begins to rally back up. So that implies there's still more room to the downside. And speaking of moving averages, look at the nice, clean picture of bearishness. Let's put it back on the weekly, though, where we belong. And we can see that drive to the downside. What this looks like instead was that we found a minor support. We rallied up a little bit. And this is just the lift into resistance before rolling over and continuing to the downside. That would make more sense. As much as we need bonds to go up, right, that those bond bulls need to get in here and do their job, it doesn't look like we're going to get it. We can see last year, if you think about the S&P and the October surprise and the flip and the run back up, well, that was also the same time that bonds bottomed out down here and the real defense started. So we've been seeing them try to come in and defend this a little bit, but not like we had back here, right? So it's like the junior team right now is trying to get it done. And if the junior team can't do it, then they'll just get out of the way and let the real ladies get the job done, right? And they'll come in and get it done. Very likely it'll be down closer around $90. With US dollar Japan continuing that drive to the upside, we got to continue to have the expectation of gold and silver and miners headed to the downside. That hasn't changed any. So we're still weak or negative precious metals. There's no expectation of that changing. And energy has completed this move, the same move that we've been dealing with all year. And if you didn't get it, you might still have a chance for a legged in iron condor. Now, the way a lot of people like to do this is they'll build it out of the money, and I don't like that. So, they would use something like an 86.84, just for an example, and put on a call credit spread up there out of the money, getting, I don't know, one third the width in credit. Okay, I mean, it's not bad. Then once it gets down here, they'll run the same thing on the put side. And now that you've got both sides, you've got yourself an iron condor that you legged into. It's not risk-free, but it's still not bad. I'd rather run it right at the money. That way, if you wanted to do something like 82.80 and you collect half the width in credit at any point along the way, whether it's, tomorrow, next week, next month, when we're all the way down here, at any point, you can put on a put spread at the money, getting half the width of the spread, another $2 spread. And if you can match that 1-for-1, you now have a risk-free trade, whether it's $10 wide in total, or if you're doing the entire range. So I like that, right? It's easily defendable. It puts you into a trade that cannot lose, other than maybe commissions. And Bob's your uncle, right? I mean, what's not to love? So just something to consider. The target is anticipated back down into that 74, maybe 72 area. We do have some major moving averages because this is a weekly time frame. So that's a weekly 50 and a weekly 10 and a 20 and a 200 to get through. Now, we still don't consider those to be support and resistance, right? They're just areas where, say, areas of interest. And oftentimes those become a benchmark or a line in the sand for, say, a program to activate an algo to do its job. Banks got hit pretty hard yesterday. Very likely that we're not done yet. We are interacting with that 10 and the 20. Kind of still want to see these guys maintain above that 10 week, right? Remember, they got whacked on that banking crisis, and then the market, they came in and played save a hole on those guys, lifted it up. We got above that 10. It's kind of a benchmark line in the sand. We want to keep it. Now, if we were to get a little more fancy and start drawing some trend lines on here, could maybe do something like that. We've still got a low that we can interact with, or the consideration that this is just a big Busby. And Busbys are the expectation of old resistance becoming new support. And if we do bounce there, then the target is back up to the top of the Busby, 49. Busbys very often start a trend. So, something to think about there. All right, we're looking at the FANGs here. We've got Google, NVIDIA, Meta, AMD, Snow, Amazon, Netflix. It's the group, right? Yeah, you can do that on TradingView just as easily as you can do it on Thinkorswim, right? So I know I always talk about how awesome Thinkorswim is, but yeah, you can do the same thing here. Right? The idea is, what are the FANGs doing this morning? Yeah, they're down a little bit. All right, let's get into the good stuff. So we got 8:15, 8:30, 9:15, 10 o'clock, 10:30, 2 o'clock. Have I mentioned watch the clock and that you can get 15-minute time frame economic data? This is why when you're running a small account, you really want to watch the clock. If you're trying to run a tight stop in the futures, or even just in options, I guess, if you're running a tight stop trade, you've got to know when the flow is going to pick up, because it can be just enough flow to kick you out of a good trade, and that just sucks. All right, they've been defending that low pretty well this morning, 44.50-ish, 44.47. We can see that there's a voodoo line here. That 44.50 is a voodoo. Then we've got this cyan line right there. That is the Globex open. We've got a red line way up here, 44.76. That's the ADR half. So if we think about, where we opened and which direction, ADR half. So expanding this chart a little bit, just so we can see those two lines a little better. The yellow lines are the ADR full. That's 4,400 to the downside, 4,500 to the upside. Considering, where we closed last night and a full ADR move in each direction, as opposed to a half of an ADR move, which would be 44.76 and 44.30. Right now we have a missed daily pivot. The daily pivot is over our head and we haven't touched it. Markets touch their pivot points generally about 80% of the time. So when we don't hit it, that actually means something tomorrow. It doesn't quite really mean anything today. If you want to learn more about missed daily pivots, whether you use it as a trade or use it like I do, more of an analysis point of view, you can just check YouTube for missed daily pivots. You'll find it. Rob and the Knoxville and the whole shebang, right? You can't miss it. Just Google it. I don't trade that strategy, but I absolutely pay attention to pivots from the perspective of, have we interacted with them, hit them or not. We are underneath that weekly pivot point as well. And when we are underneath it, we're bearish. The thing is, though, we can be underneath it and be driving back towards it, which wouldn't make us bearish anymore. So just kind of keep that in perspective. Also, when I strip all of this stuff off of here and just, make it the way that I like to look at price, just get rid of all this stuff. That is a pretty flat area of price. And when you look back, where have we had that in this turning point through all of this downward move? Now it's a very small amount of price at this point, considering, how many days we've been continuing this downward drive. But it is the start and it's at a key level. 4450 area has a lot of optionality to it. It's a big deal, right? It's a very structurally sound level of major importance. Now we can wick below this level, no doubt, no argument whatsoever. But this is from Spot Gamma. It's a part of their snapshot that they do. And I just grabbed a picture of it this morning to kind of point out some of these levels of concern. 4,500 short-term resistance, 44.25 short-term support, and the discussion of what's going to happen if we break that support. Current positioning in optionality suggests that 4,400 would be a major interim low, with traders likely taking a directional cue from Jackson Hole off of that cue. It would be a significant risk off to go below that level because dealer negative gamma will increase drastically. So it's a really big deal, right? That where we are at and the idea that we can go a little lower, that's not going to be too big. Now that they were referencing SPX, so we'll just swap over there so the numbers match a little bit better. 4411 would be the cog line. 4400 would be the area that they were just talking about. And we can wick through that, right? We can get a little bit lower and we could see the bottom of this candle or even, the open of that candle. That's from July 10th or the week of, second week in July. 43.94 is the bottom or the open. It would be getting below that level where things really start to get nasty. and negative dealer positioning and all of that, right? The optionality of things. So until or unless we get to that level, there's no reason to believe that we're going to do anything more than chop around, digest some of this pullback, and look for them to play save a hoe, whether through Japan or whatever, and then to move up, right? That's the base case scenario at this point. Yeah, I did. I changed my my Thinkorswim just a little bit. I thought maybe it'd be easier for you guys to see it if I made it bigger. I'm surprised you noticed that. So this morning, KWeb, the China Internet ETF, the whole China ADRs and that group, they're down the most, 1.5%, followed by Nat Gas, which isn't much of a surprise. That whole thing has just been whatever, right? Then you've got the FANGs or the Apple, Google, Amazon, the whole shebang, basically nothing. Go to the other side of the coin. We don't have anything except a triple leveraged product that's up more than 0.5%. So we got nothing there. Let's see if we could find something a little better than nothing. Crypto, okay. Riot, Mara, Coin. I'm not seeing, oh, there it is. Aha, I was going to say, I'm not seeing anything in here of value. So Coin woke up. Nice push to the upside. You got to consider that a liquidity gap, right? So, it did the same thing the other day, especially with nothing else making the move. See what's going on in Bitcoin itself. So Bitcoin has that significant drop to the downside like everything else this morning, and no real drive back up. And I've got a quarterly level that says it shouldn't be making any kind of moves too soon yet. So they won regulatory approval to offer crypto futures in the US. Very nice. So that's why Coinbase is making a move this morning. Speaking of crypto futures, I was talking with somebody yesterday about these. They were just asking, can I trade futures in the crypto? Yes, you can. There's a micro, there's a nano. So, I mean, it's the smallest risk futures trade you'd ever take in your life because every tick is a nickel. Seriously, like, 5 cents. I'm not using rounding measures or any sort of, optionality attached to 100 to the backside. It's literally, it moved this much, you made 5 cents or risked 5 cents. So you can do the nanos on Tradeovate. Just look for them. So, yeah, there's always that. We've been looking for Bitcoin to make a move, which would help with the NASDAQ to also make the move. You got that 70% correlation. This is just the start, and it's only Coinbase. So we need to see contagion or, collaboration starts here, starts maybe bleeding over into Mara and Riot, and then we start seeing it in Hive and Hut, and it just keeps going, right? So it's a start. It's not enough. Looking at it on the weekly, we we did get underneath that 10 period moving average. We're back above that. Well, we were back above it in coin. This is a very beautiful TRB setup. I mean, that is just fantastic. So, depending on how you draw the line or anything like that, we really don't have a base down here. Without a base, I would say just focus on the last candle. Use that for your line in the sand. Either 50%, so if it gets above that, you can pull the trigger and go long, or let it get entirely outside of last week's level, which would be on this sorry little trend line that I drew there. Don't let that thing confuse you. A break above last week's high would trigger the entry, and then you'd have your long play. TRBs are really nice because it can make that entire move in a single candle. We'd also be going red to green, right? We closed yesterday at the lows down here. This morning, we're already pushing above the entire week, the current week's high. So yeah, something to think about. Yeah, for those of you trading futures who don't like paper because there's no real risk, trade Bitcoin Nano. Your risk is literally a nickel, but it is real risk, and you're no longer trading paper. Something to think about, right? I don't know. Just thought I'd throw it out there. All right, so that's the Bitcoin stuff we can see through Mara. If you do want to go that route, I would watch the others as well, right? Especially if you're going to trade Mara itself. Watch for the peers to get involved so that it's not just Mara anymore. Semiconductors are behind that. Not really promising, by the way. So Intel continuing to fall out of bed. You got AMD, nothing. NVIDIA, same thing. There's nothing here. They're holding their own, sure, but I mean, it's not like we're getting some sort of inside day breakout or anything. So going in the other direction, instead of what's up the most, what's down the most, you got the EV plays. Lee, Neo, Nikola, Rivian, Tesla, XPEV. Those are down this morning collectively. It's more likely, though, that it's individually. Neo's getting a significant gut punch. I don't like shorting from the hole. So, if I was going to short the EVs, Neo wouldn't be my first choice. XPEV maybe. It hasn't fallen as much. It's still inside yesterday's range. So, at least you're not shorting from the hole. Tesla, that's a continuous, consistent, persistent move to the downside. 227.73 in the pre-market before it turned around and started coming back up. We're at 228. Kind of ID that out here. 228 and a half. It's about at this 50% mark. Nope. Well, I was wrong. It looked like about 50%, but that's why we measure. So 50% is where we closed yesterday in Tesla. And it fell beyond that. We've got a gap to close overhead, and doesn't look like we're going to get that done anytime soon. The next stopping point is 212.5 in Tesla. But again, I wouldn't want to short that from the whole, right? What I'd also be watching for as we get into the open is for this to pop to the upside. Even if we do continue to fall through the day today, I would still expect first to pop to the upside. One, maybe to suck some bulls in there and then trick them and dump it on their head, but also just the way price action works. So if you did want to go short in Tesla, maybe wait for it to get that pop back to the upside, at least close to where we closed yesterday, somewhere around that 232, and then continue to fall, right? Kind of like how yesterday, as we got closer and closer to the open, Tesla started moving back up, and then, you know, either at the open or right before, it popped up, hit its head on the previous day's high, and then down it went. Give it that chance to come up off the bottom first. And then we've got the China ADRs, JD, PDD, Baba, and Baidu. I added NEO and a few others, but you know, there's really no reason to have NEO in there since we've got the whole EV list. But I'm not going to change it at the moment. Looks very similar to the EVs. We're looking at Baba here. Same thing, basically. It is a measured move. Nearly perfect looking at it. Kind of just eyeballing it, but it still looks about right. Nope, overshot a little bit. So I would be expecting this also to kind of stabilize, lift up a little bit, get a nice little bump upwards before continuing the move to the downside, if it does continue to the downside. And that's the thing, I wouldn't get all bared up in these things, especially a lot of those EV plays. If the only thing is sentiment due to Tesla creating a little bit of a price war, you know, that same thing can flip right around. Sentiment can change. Baba and Baidu and all those other China ADRs were getting a anticipated stimulus lift, right? They were all thinking China was going to come in and play save-a-ho, and that was kind of the reason for that moving up, right? The state banks were ordered to buy the stock, and so they went out and bought a bunch of stock. But they can't keep the buying pressure up, right? And without China following up with real stimulus measures, this didn't hold up and down it went. That might make those a nice short back down to 80, right? Say from Baba 103 down to 80. You could focus on that trend line. You know, if you wanted to get more specific. Or you could just focus on breaking to the downside after that last big candle, right? If we get below 90.2, that would trigger the short, and your target would be 86 and then down to 81. Just buying out of the money puts at 81 or 80. So I doubt that it has 81s. We'll see. Yeah, 80. $65, they're not bad. You could reduce that risk just turning it into a spread and risking $40. You're risking $40 for a chance to make $4.60. Now, obviously, you won't make $4.60 even if the trade was a blowout home run, because you would have to take assignment for that. You would end up with options in the money and you'd have to hold them into the close. So we never go for max profit. And if we don't go for max profit, we shouldn't take max loss either. Cut the number in half, say, set a stop at 50% and set a target at 50%. So now you're risking $20 to make 220. Oh, that's not bad. If we are going to start seeing everything turn around, it's very likely that we'll see it in small caps and things like that too, right? So keep your eye on IWM today. Some of our telling tools aren't telling the story, especially when we start to get that disconnect between the dollar and the 10-year. So we want to continue to see this 10-year make small, reasonable size moves, nothing drastic, nothing extreme, but continue to sell off and get down below that, at least below yesterday's low, be a good start. And then, make a new low on the week, but no fast, sudden moves. Same thing with the dollar, needs to hold below that 3.5 level. But even better would be if we can get below yesterday's low and start working towards that quarterly level of 102.50. That'd be really good to see. Bank of Japan needs to calm down over here, right? The US dollar Japan, not Bank of Japan. US dollar Japan needs to calm down, get away from that 145.90 level. Just nice and easy, right? No fast, sudden moves. Got the S&P and the NASDAQ both flirting with their VWAP structure. If we can get through VWAP, we'll target the Globex high. And then if we can get through that, we'll start working on yesterday's RTH open. It'd be a nice move back up to 15,225 for the NASDAQ. For the ES, we got that major voodoo line, 44.74. That's a major one, right? We got that minor one, 44.59. I'm not too worried about. That 44.74 is going to be a little more tricky. Still, if we can get through VWAP, target Globex high, get through that, target that voodoo line, and then target RTH open of yesterday, 44.84. One step at a time, right? Level by level. That's a really nice 2-bar reversal. It just needs to stick, right? Same thing back here, nice 2-bar reversal, but it didn't stick. Had a nice run though. Yeah, see, the Russell doesn't look half as healthy as those other ones. Not measuring its levels very well either. I think it would come out of small caps today, so it's worth keeping your eye on those. Of course, you've always got your standard deal. Keep your eye on KRE and NY Fang. That's regional banks and then your mega market cap tech names. You don't need both. One or the other is fine, but generally speaking, finance just doesn't have the gumption to carry us, right? It can't do it alone. So if it is only finance, we need finance and consumer discretionary combined. If it's just tech, it can literally just be tech. So no issues there. But it'd be better if we have both. So far this morning, they're holding. That's not good enough, I know, but it's a start. All right. So everybody be careful, be safe, watch the clock today. It's a big deal. This afternoon, those FOMC minutes, if they surprise, things can get a little violent. So just be prepared for that. 2 o'clock, right? Otherwise, I'll see y'all tomorrow.